Hey everybody, this is Ted Bauman here. As you can see, I am in an empty office. That's because I'm leaving for Cape Town on Saturday and my goods, except for my laptop and my camera, are already on their way. Nevertheless, I think it's important that I say something about recent developments in the financial markets in the United States and the effect that it's likely to have on stocks, but also how it will affect the so-called macro regime, the big picture within which the stock market operates. Now, as you know, since my last video, the market has steadily pulled back. Basically, we've seen an across the board pullback, I think, based on the collapse of people's mistaken belief, I think, that the Fed would slow down its rate hiking. All of the underlying economic data that we've seen, the critical indicators, employment, unemployment claims, all those things indicate that the economy is still going very strong and that there is still going to be a lot of inflationary pressure, particularly in industries that rely on a lot of labor. And that means that the Fed is likely to continue raising rates. So up until probably about a month ago, maybe 3 weeks ago, there were people in the market who seriously believed that we were close to the end of this thing. And that accounted for the mini boom, mini rally, I guess, that we had from October until February. Now, clearly, they've been disabused of that notion. The Fed has signaled that it's going to continue raising rates. Problem is that if you raise rates rapidly, the financial system doesn't have a chance to adapt. Now, there are parts of the financial system that can adapt very easily and very quickly. For example, the big Wall Street banks are much better capitalized. They are much better regulated than they were in 2008. And so we don't see any problems on that score. The problem is regional banks. Regional banks are, banks that will operate, say, in the Southeast or the Northeast or California. And Silicon Valley Bank, the one that crashed last week, is such a bank. Now, the reason why regional banks are so important to the economy is because they tend to serve specific markets. SVB served the startup market in Silicon Valley, hence the name, which meant that they were part of the whole flow of cash that was going through from venture capitalists to startups, and then basically hoping that those startups would become big winners. Now, when a venture capitalist gives a lot of money to a startup, that money is designed to fund its operations until it develops a product and is ready to start marketing that product and making money from it. And that money has to go somewhere. And Silicon Valley Bank was a place where a lot of that money went. And so what's happened over the last decade or so is that all these startups who've been getting money from venture capitalists desperate for yield, willing to write billion-dollar checks, multi-billion-dollar checks to almost anybody who could fog a mirror, as somebody said the other day, meant that there was a lot of money that needed to be stored in a bank like SVC, Silicon Valley Bank, SVB. Now, the problem there is that when a bank takes in lots of deposits, it has to do something in order to earn money on those deposits, or else it can't pay any interest. Now, even though the interest was very low on these deposits, they still had to do something with the money. And of course, as you know, in the banking system, we do what we call fractional reserve bank, which means that the bank certainly doesn't have all the money in its own vaults at all times. It takes that money and invests it in other things in order to earn interest on it, which then becomes its profit so that it can then pay interest on deposit accounts. Now, everything is fine as long as interest rates are relatively stable and predictable. But what's happened here is that as interest rates have risen thanks to the Fed's tightening cycle, people look at their deposits at Silicon Valley Bank and similar banks and say, hey, I could get better money or better interest if I transfer my money somewhere else. So that forces banks like SVB to continue raising their deposit interest rates, in other words, what they pay to people for their deposits. But what about the money that they invested before the Fed started hiking their rates? Well, in SVB's case, they invested a lot of that money into long-dated Treasury bonds that pay interest based on what the original purchase price was. Now, the way bonds work, Treasury bonds, is that you have a coupon right? And you have a coupon interest rate on the bond. But the real action is when the price of the bonds on the free market falls, increasing their current yield. Don't worry if you don't get all of that. But the bottom line is that somebody like SVB, which holds billions of dollars worth of long dated treasuries, is earning interest from those treasuries that is a pittance compared to what they have to pay to their depositors for their interest. Now, they can't just offload those bonds because they would take a big hit. That means that, if you have $1 billion worth of 10-year treasury bonds that you bought at a yield of, let's say, 0.5%, and they're now yielding close to 4%, that means you're going to take a big hit in terms of the asset side of your balance sheet. So what SVB decided to do was to sell some of these bonds anyway, take a bit of a loss, and then also issue some convertible bonds of its own to raise cash. Now, that's probably the worst possible thing that it could have done, because it meant that once the news got out that the bank was trying to raise cash, everybody thought, let's get our money out of SVB as quickly as we can. And so it was a classic bank run. People were talking on Slack channels, they were talking on WhatsApp groups all over Silicon Valley on Thursday and Friday last week saying, hey, we got to get our money out of this bank. And of course, if you do that, it's a self-fulfilling prophecy and the bank has to collapse. Now, fortunately, the Fed, unfortunately anyway for the depositors, the Fed decided to intervene with the support of the Treasury Department in order to guarantee that the startup companies that had put their money into SVB will be able to get their money back. Now, they're doing this essentially by saying, all right, SVB, we will take your treasury bond holdings at their par value. In other words, not their current market discounted trading price, but what they're actually worth. So if you have $1,000 treasury, we'll give you $1,000 loan against that collateral. That allows the banking system to kind of resist this problem. But it's another type of bailout that has been made necessary by the fact that the Fed's low interest policies over long periods of time created this environment in which, the normal rules of monetary and financial economics didn't seem to apply. Now that the Fed is raising rates, you're starting to see strain in the system. It's like if you have a big steam engine that you haven't run for years and all of a sudden you try to bring it back up to full boil, you're going to find some leaks in some of the valves that haven't been attended to for a while. And SVB is such a valve. Now, what does that mean for your stock holding? Well, the first thing is that, like everybody else, my stock holdings are down big time in the last week in particular. I tend to be invested in financial stocks simply because they pay high dividends, and also because I think that in the long run, I think they're going to provide very, very good returns. But obviously, if people are worried about the health of the global financial system, they're going to sell bank stocks. And I'm holding through this. And I think, generally speaking, this should have been expected. In other words, it's a surprise on the day it happens, but in retrospect, it's no surprise at all. There are going to be other banks out there that are going to find a mismatch, what we call term and rate mismatch between their, the asset side of their balance sheets and the liability side of their balance sheets. In other words, they have long-dated, low-interest-paying assets versus short-dated, high-interest-paying deposits from their customers. They're going to be banks like that. But now that the Fed has created this term facility that allows them to exchange some of those long-dated assets for injections of cash, that should nip the problem in the bud. The point, though, is that this is part of the big unwind that we're going to see as this whole process of inflating asset prices, of building a house of cards based on very, very cheap money is being wound down. I've talked about it before as a controlled demolition. Well, just think of this as part of that. There's no question but that the Fed and other financial authorities are thinking ahead on this issue and thinking, well, we know we have to be aware of this. They do not want a cascade of bank failures, and I don't think that is going to happen. Because remember, at the end of the day, a lot of these rescue plans are paid for by levies on the banking system as a whole. If you're part of the Federal Reserve and you're a bank, you have to pay certain levies which are used to fund programs that address systemic risk. So I don't think this is going to lead to a collapse in the global financial sector. I think we'll see stocks recover as the dust settles. but it does indicate that we should be looking for pressure points. We should be looking for places in the global financial steam engine that are starting to pump out and whistle where they shouldn't. And that would be my recommendation to you. Look for where you've got money. Look for where, what kind of financial networks that the companies that you're invested in have. And above all, look for companies with strong cash flows that can pay payroll out of their own income, as opposed to money sitting in a bank like SVC or SBC. That's that's what you want to do right now. Anyway, this is Ted Bauman signing off. My next video to you will be from Cape Town starting next week.